Hey guys, welcome back to another video. Happy Friday, and I hope you guys had a wonderful Thanksgiving. For those of you who decided to work through this Thanksgiving holiday, I hope you're staying safe. I hope you managed to grab those loads that take you through the weekend until Monday. We didn't. One of our trucks didn't. So unfortunately, that truck pretty much lost 5 days, but the good news is that my business partner did end up deadheading home and got to spend 5 days at home, which is something that I'm very grateful for. All right, it's the end of the week, so it's time to talk about what happened to the freight market over the past week and where do dry vans, flatbeds, and reefers need to stick to, which markets they need to stick to next week in order to grab relatively better opportunities. Now, a quick spoiler alert, unfortunately, it doesn't look good, guys. Anyway, ready? Let's go! Okay, starting with the net change in trucking authorities. Well, as of last week, it's pretty disappointing because as of last week, only 14 carriers actually left net. And this is the smallest amount of carriers lost since the beginning of the year. Now, when we take a look at the amount of freight, which is the white line, versus the amount of active authorities right now in the market, which is basically supply and demand, we can see that year to date, freight volumes actually increased by almost 23%, while carriers, the total amount of carriers, decreased by almost 5%. Next, we have volumes versus rejections. The overall freight volume is the blue line, the rejections is the white line. So freight volumes are actually, this is us right here, they're staying strong despite the weaker economic conditions. There was a huge jump right before the Thanksgiving holiday. The rejections were climbing up since the beginning of November, but now, if you look closely, they did make a U-turn. However, rejections going up during this time of year is completely normal because capacity decreases. People want to spend more time with family. Currently, rejection levels are at 4% at the moment. Now, if we take a look at the same chart just week over week, we can see that since last week, volumes increased by 7.7%, whereas rejections also increased by about 6%. Again, this is not a sign of much because this is right before the Thanksgiving holiday where capacity does tend to decrease a little bit as carriers try to spend more time at home with their families during this holiday season. All right, onto the spot versus contract spread. How much more are contract carriers earning than spot carriers? Well, currently it is 76 cents per mile. This is the difference between what the spot market pays and the contract market. Now, this gap has been decreasing, as you can see, but just recently it did make a U-turn. A quick reminder for you guys, this chart is about 2 weeks delayed. So we're looking 2 weeks in the past. Surprisingly, diesel continues to be a source of good news. It's continuing to go down. Currently, the national average is around the $4.29 per gallon mark. And if we take a look at the markets, the different markets, we can see that every single market, even California, saw a diesel price decrease over the past week. All right, now let's talk about flatbeds specifically, starting with the spot market volume. Well, as of last week, nothing really changed in terms of spot market volume. It's still low. It's lower than the 5-year average, lower than the past 2 years. So not much to report here, but it's normal for volumes to go low towards the end of the year for flatbeds. Now, in terms of spot market rates for flatbeds, we can see that they actually had a tiny little increase, and we're currently at around the $2.27 mark when it comes to flatbed rates, if you want to see, and I'm going to attach these down below. Still, we're below that 5-year average, but not much below it, which is interesting. Now, looking at the DAT market map for flatbeds for outbound loads, we can see that the Pacific Northwest, which was always hot, is starting to contract. Oregon is still hot. And then the South is also starting to contract. Now, even more interesting is if we look at the inbound map for flatbed loads, where are these loads going, right? The hotter, the redder a market area, the more loads go there. Now, about I don't know, a month ago, all of this right here was pretty much red. Excuse Snickers, she's barking. She's pissed off at somebody. But now you can see that the inbound market is also contracting. And the only thing I see here is the fact that volumes are decreasing. So there's not as much stuff moving to these places, even the dead markets that used to be a very popular destination for flatbed freight. All right, now we have reefers, starting with the spot volumes. We can see that reefer volumes have been flat over the past 3 weeks, despite the fact that we should be seeing this kind of pattern right about now. So that is a bummer. There is no pattern, no seasonality happening right now, at least not for reefers. Now, if we look at the spot market rates for reefers, we can see that they have increased and then stayed flat week over week, even though we should be seeing an increase right about now. Currently, reefer rates are at around $2.45 per mile. As a reminder, again, this includes those short 200, 300 mile runs, which pay $3 usually. So for long loads, obviously, $2.45 is something that I haven't seen in a while. But yeah, unfortunately, that seasonality that we were expecting for reefers, it's just not happening at the moment. Now, in the general freight market for reefers, if we look at volumes, we can see that as a whole, pretty much volumes remained unchanged. There were some areas, the blue market areas, that did experience an increase, like Northern California, Phoenix, Arizona, Indiana, Arkansas, Mississippi, Wisconsin, Minnesota, some parts of Florida. There were also some small decreases, but as a whole, volumes really did not change for reefers last week, which is interesting considering the fact that it's pretty much holiday season right now. Now, if we take a look at rejections, we can see that this map is a little bit of a source of better news, I suppose. Yes, it's a lot of gray areas, which means no changes, but we can see that the Spokane, Washington, Idaho, Utah, Nebraska, South Dakota, Arkansas, Mississippi, Tennessee, parts of Georgia, even parts of Florida, Indiana, there was an increase in rejection rates. However, considering the fact that, again, holiday season, right before a huge holiday, Thanksgiving, if we look at the big picture here, we can see that rejections are, yeah, they happen somewhere, but they're nowhere near where they're supposed to be given the current time. So the question as always is, where do you have to go if you have a reefer next week? Well, we have Spokane, Washington right here, where 1/3 of all loads are getting rejected. We have Twin Falls, Idaho, where more than half of the loads are getting rejected. And then we have Fargo, North Dakota, which is also showing that more than half of loads are getting rejected. Now, yeah, these 3 market areas are, I mean, relatively better. This is where you can grab opportunities, but all I see when I look at this map is just the comparison to the prior weeks and months. And I can see that like the Midwest, it contracted quite a bit. Even the Pacific Northwest contracted quite a bit. So the good areas, they are contracting at the moment. Then we have dry vans. So starting with spot market volumes, we can see that there was a small increase in volumes for dry vans last week, and it did follow slightly that 5-year pattern where there's also an increase. The question is, what did it do to spot market rates? Well, let's take a look. We can see that despite the fact that volumes increased on the spot market, rates actually went down to around the $1.80 per mile mark as of last week, even though what we should be seeing according to the pattern is an upward trajectory. What we actually saw is that it was flat and then went down. Now, if we take a look at the general volumes for dry vans in the general market, we can see that for the most part, there were decreases or no change. Yeah, there were some blue areas as well, but if we're looking at the big picture, there were some significant increases in volume in Phoenix, Arizona, and this part of Michigan. I have no idea what it is. I forgot to look it up. There were also increases in West Virginia, parts of Indiana, Kansas, Oklahoma, Arkansas, but really the significant ones were in Michigan and Arizona. What about rejections? Well, in terms of rejections, it's actually a much better map. We can see that there were some significant increases in rejections in the Midwest, in some of the South, in some of the East Coast, even in the Northeast. The only place where rejections didn't happen or decreased significantly were the northern states and then the west and the plain states. So the question again is, where do you have to go next week in order to grab relatively better opportunities if you are a dry van operator? So we have Wisconsin, Iowa, and Rock Island, Illinois. These are the only 3 market areas that currently have over 10% rejection. Now looking at this map, yeah, 10% rejection is pretty much nothing, but considering the current situation, you have to stay in relatively better markets. So I still recommend staying in the Midwest, sometimes hitting the South. Stay away from the Northeast and the West Coast. It's dead there. So there it is, guys. Usually during this time of year, we see volumes on the spot market as well as rates start to increase, but unfortunately, it's not the same this year. Now, I do have a theory, and you guys tell me if you agree or disagree. While trucking companies are closing, we see that in the net changes in carrier authorities. We know that the bigger companies are parking their trucks and not hiring as much. So capacity is theoretically decreasing. Something that we do not measure for, and it's impossible to measure for, is how many trucks there are actually on the market. Why do I say this? Well, because there might be a ton of carriers who did not shut down their authority, but they simply parked their trucks waiting for better times. My theory is that those that parked their trucks waiting, they just got back into the market trying to monetize on this holiday season, therefore increasing capacity. And another theory I have is that the temporary decrease in capacity that we see during the holidays is not as big this year as it is usually, simply because the market is really bad and people are choosing to run through the holidays to try and cover at least some of their losses. What do you guys think? Let me know in the comments. Anyway, wishing you all an amazing rest of your week and weekend, and I'll see you in the next video.